This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 232 is brought to us by Bybit. Traders made so much money trading Bitcoin all the way down and then immediately started making money all the way up. I mean, you could be relatively stupid and still have made really good money trading Bitcoin in the last 3 to 4 weeks. How are you guys not doing this? Now, I'll tell you what's not stupid is joining up with Bybit through my link, because you not only get the best crypto platform in the world, you get so much extra just for doing one simple thing. But you do have to go find the link. It's not that hard. Go down to the show notes, click on the link for the Bybit blog. Read the blog, make sure it's for you, and then my affiliate link is going to be at the very bottom. Click it. Get signed up, get deposited, get trading, and start getting all the bonuses too, because with Bybit membership has its rewards. It is the 10-Minute Contrarian Podcast, and this is going to be one of those episodes that is probably not going to draw numbers, especially because it's a holiday weekend in the U.S., but I kind of do these episodes when I do them on purpose, because I don't think you're ever going to want to not know about what we're going to talk about today and the special alpha in terms of how you can use these things that I'm going to give you throughout this entire episode. So for checking this podcast out on the holidays and for being a real one, even though you might have seen the title and it's not really the asymmetrical, ball-tingling, crazy upside, excitement type topic, man, can this one go a long way, long term. You'll see what I'm talking about. So I wanted to kind of continue off of the Substack blog I wrote last Monday. If you didn't know, I do have a Substack now. It is free, and the link from now on will be in the show notes of every podcast episode. So you can go sign up, and you should. There will be topics there that I will not be talking about here. And for a lot of you who read last Monday's blog, it was kind of a game changer, no? If you didn't already know how to do that, now you do, and it's going to put you at a huge advantage over not only individual investors. You already have a huge advantage over them anyway, but a really big advantage over institutions as well. And today's episode is going to run along those same themes. Now, I will say, too, you are really going to want to be using TradingView for this. And in particular, you're also going to want a TradingView subscription. Because with the subscriptions, you can put your entire algorithm on TradingView instead of just 2 indicators like you can with the free version. And you can hold a lot more pairs in the place on TradingView where you hold all of your pairs. I can't remember the name, but you're a lot less limited there as well. What I like to do is take all the pairs that I have saved up over time, and at the very last trading day of the month, since we use the monthly chart here, go in and just rifle through all of them. It really doesn't take much time at all. And then on a piece of paper, write down the ones that actually have a signal one way or another, or have a signal on the way. And then I can start doing the rest of my work from there. And oh, by the way, I now and forever will be able to give you a discount on your TradingView subscription. So that is also going to be in the show notes. You'll see the link for that and my blog towards the bottom, because in all candor, I make more money off of my brokerage affiliates than I do getting you a $15 discount off of TradingView or my free Substack. But that's where you'll find them now and forever. But let's go ahead and talk about the topic at hand here. And we are talking about the SPDR family of ETFs. You will recognize them by the spelling SPDR, and they are issued by State Street, which is one of the big boys. They're so big, a lot of people even accuse them of being a little too influential, maybe part of the Illuminati. Who knows? But they have what are, in my opinion, the most helpful suite of ETFs out there in the form of these spiders. And you will notice them because they mostly, not always, but mostly start with X. I'm sure if you follow finance even a little bit, you have seen these numerous times in the past, but we're going to go over them all today and kind of differentiate between the two categories and then give you a really great strategy of how you can best utilize these even better than the institutions do. And this is not my opinion. This is a stone cold fact. So let's go ahead and get into it. Now, there are two main types. There are 11 select SPDR ETFs, and these are the ones that most of you have probably heard of in one form or another. And they are industry specific, and they all start with XL. And they tend to move fairly slowly compared to a lot of ETFs, especially compared to comparable ETFs in the same space. Now, this may not be exciting to you personally, but stay with me here. That is not where the magic is. Now, I will say they are all quite liquid because institutions actually do like them. Remember, institutions really, in a lot of ways, need to be more stewards of downside risk than they do anything else. So having something that is less volatile is actually very positive for them. So they like the lowered volatility. And if that's something that you like, then you're going to really love these. And you know who also likes these a lot? People who short the market. Now, I don't know if that's you or not, but when you have lessened volatility, that actually helps you when you short, because the one thing you really want to be very, very cognizant of, if you are somebody who shorts the market, is not getting short squeezed. And when you have a market that mostly bulls, you are in danger of this almost all the time. So lessened volatility is actually a good thing here. But for the rest of us, we more or less use these as overall indicators to tell us which sectors are likely going to bull going forward. Or on the other side, these things might be triggering your exit indicators, indicating that it might be time, if you have any stocks in any of these sectors, to really start watching them closely and maybe start taking profit on them as well. Because what's great about these is when you use them not as investment vehicles necessarily, but just as indicators of where the sector is going. If you are getting a bull signal, and that bull signal is correct, then you should all have systems to where these signals are going to be correct more than they're not. And the farther back we zoom out, the more accurate everything is. So you should definitely have something like that. But if you have a bullish sector, chances are almost everything in that sector is going to bull too, with a few exceptions, upping your chances of success even more. And conversely, if you find something going into a bear cycle or a sector going into a bear cycle, I would say it's probably a good idea to take all of the stocks in that sector and then just simply leave them alone and move on to something else. I mean, even if I was getting a bull signal on one of these stocks, I would much rather put my money in a stock that not only had a bullish signal on my chart, but was also in a sector that was bullish as well. I would love that. Why swim upstream against a bearish sector? But your average investor doesn't do this. Just think how advantageous it would be if they did, but they don't. I mean, your average investor can't even read a chart. Not only can we read charts, we are very good at it. We use superior indicators on superior time frames, and we only put our money down in sectors which are in a bull cycle. I mean, every little thing we do just adds more and more opportunity for us to win. I love it. Absolutely love it. You might be wondering, okay, this is a bit of a departure from a lot of the asymmetrical investing talk that we love so much here at the 10-Minute Contrarian podcast. But don't forget, we also talk about slower investing, like our dividend stocks, like our closed-end funds and our bonds, and even big board stocks too, for a couple reasons. One, I know for a fact a lot of you are already in these, and that's perfectly fine. It's good, actually. The stock market's been doing very well, and I'm sure just by proxy, your stocks are doing very well also. But we all kind of fantasize about that time where we have allowed the commodity cycle and the precious metal cycle to completely play out. And we can finally take some really great profit on the absolute multiples we have made, not only in that sector, but possibly in crypto too. With a lot of those, especially the altcoins, they might become the tech companies of the future, and you're still going to want to have some money there. But there will come a time where you should also probably take half out and let the other half ride. And what are we going to do with all those riches we just made? All those crazy gains that we finally took some real profit off for? Because look, there will be a time to do that. Commodity cycles are just that. They're cycles. They don't last forever. As much as we like to think they might, that's not how they work. There will come a time and a place to sell these. And then once you do that, where does that money go? Does it all go to cash? No. Cash sucks. At that point in time, the contrarian thing to do will be to enter a stock market that is probably going to be a lot less popular to invest in than it was all throughout most of the 2010s and 2020s. And that's great, because that means we get to get in low. Now, the problem is there are lots and lots of stocks out there, just on the U.S. markets alone. And if you just want to put your money in some of the large ETFs that just track the index, that's fine. You should probably do that, but you're also probably going to want to spread out and chase a little more upside and chase some nice dividends and things like that. So that's why we talk about things like this. And we want to get ahead of it. And episodes like this can serve as a little time capsule that you can go back and listen to over again, should you ever need to. But let's go ahead and do a quick overview of these foundational ETFs from State Street, these spiders that all start with XL. You have XLC, which is communication services, XLY, which we talked about on the blog, consumer discretionary, also XLP, which is consumer staples. Those two are usually inversely correlated to one another. You have XLE, which we should all know, that is your energy ETF, very, very closely tied to oil. You have XLF, which is your financials. You have XLV, which is your healthcare. A lot of people think that's boring. No, that's where your pharmaceutical stocks are. Definitely not boring. You have XLI, which is your industrials. XLB, which is your materials, which we like here at the 10-Minute Contrarian podcast. Then we have XLRE, that is your real estate. Always kind of a good one to look at, a good leading indicator in a lot of ways. You have XLK, which is your information technology. And then XLU, which is your utilities. Now, XLU is interesting because I noticed at the same time everybody finally got on board, or I should say Wall Street finally figured out what we were talking about on the podcast for a long time, that you're going to need these utility companies to power data centers. And right there, I saw XLU get a bull signal, and I did absolutely nothing with it. I think because I just bought crypto, and I was a bit low on cash. But I saw it, and I knew it was going to happen. And it sure enough, man, it went up. And everything in it did too. And I know, because I've talked to some of you, a lot of you guys got on that. I'm not going to say a lot, but there's a handful of you that were really, really savvy, really keen to that move. And so congratulations to you. But that's a really good way. If you suspect something is happening, you can always go check the spiders and see, is the market figuring this out too? And if they are, you still have a chance to get in relatively early. And that's really what makes these things so great. So add all of those to your toolbox. Whether you think they're interesting or not, I could not care less if the thing I invest in is super exciting or super boring. I could care less. Just make me money. So I would have all of these stored on your trading view and then just rifle through them at the very last trading day of every month. See what's going on. Might be nothing, might be something. And again, you can use them as buy indicators and as sell or take profit indicators, which even people who look at spiders, a lot of them don't even do this part. I'm telling you, in so many ways, contrarians, we can get the leg up on literally everybody else. But oh wait, there's more. Now, there's actually more spiders, and these are a bit more exciting. These are spiders you will find within the sectors I just spoke about. Now, these spiders usually start with X. They don't always. We'll see in a moment. But they're all part of the spiders family, but they're kind of that subset to where they're going to be smaller versions, portions of one of the 11 spiders I just named earlier. So let's read these off, and I'll try to keep them all within the same family here. So the first one is a fun one. Ticker symbol XAR. That is your aerospace and defense, and that fits into your industrials category. And then your other one in the industrials category is XTN, and that is, to me, a very boring one. That is your transportation ETF. And I just looked at it. It doesn't move that much, but it's there. Let's go to financials. Ticker symbol, not an X, KBE. This is your ETF just for large banks, which can be very helpful. And then you have KCE, which is going to be your capital markets. That also goes into your financials. Now, I know there's another one in financials. Where is it? Yes, KRE. This one has been in the news recently, and not for the best reasons. That's going to be your regional banking ETF. Let's go from there. Healthcare, fun. The funnest one. XBI, your biotech ETF. Be careful with those. Those things fly or crash often. But again, you're going to have a better chance of success investing into an ETF like this because it's going to smooth out a lot of that crazy volatility. Where are the other healthcare ones? XHE, healthcare equipment. XHS, healthcare services. Again, on the surface, boring, but check the charts. Could be something there. What else we got? On to discretionary XHB. That's going to be your home builders ETF. That goes under discretionary and materials. Also in materials, you have our personal favorite, XME, Spider S&P Metals and Mining ETF. Oh, how that thing has flown. You probably don't need to look at that one as much. We kind of have a pretty good idea what's going on in the metals and mining space. But again, it never hurts to see what Wall Street's doing too. Anything else in the materials? No. On to energy. So we're going to do an episode or a blog post on this. I haven't decided which yet, but there are two, and there are two very distinct sectors you need to be very well aware of in the oil space. Because remember, oil is the one thing that I can think of that is at low prices, but is getting very interesting right now. And there are two spiders you have to really pay attention to within the XLE energy family. The first one is XES. That is your S&P Equipment and Services ETF. And then the other one is one you might be familiar with, XOP. That's going to be your producers. Those things are diametrically opposed oftentimes. And if you understand how both of those operate and work, your chances of making money in the oil space go way up. So expect that coming in either blog form or episode form very, very soon. There's a few left, I think. Oh, yeah. In the technology field, you have XSD. That is your semiconductor ETF. Super exciting. Then you have XSW. That is your software and services ETF. Now, these, for example, you're probably aware of other ETFs that are probably a lot more exciting. But here's what I'm going to say about these. The second tier, they tend to move a lot more. I think they are far more investable than your core 11 spiders are. So like anything, take the other ETFs that are competing with these and then just simply look under the hood. See which ones you like. I would not be afraid to invest in these, or at least give them a really good chance and give them a fair comparison to what else is out there. And then let's just go ahead and breeze over the ones I kind of missed here. XPH, that is your pharmaceuticals. XTL is telecom. XRT is retail. And I think I got most of them. But if you ever want to, you can just maybe go to AI and say, hey, give me every single spider ETF out there and tell me what they are. And they will pop up. And then you can just kind of clip and rip and place them into the charting software of your choice. Now that we have listed all of them exhaustively, let's go ahead and get to the solutions portion. That's my reward for you listening to me name all of the SPDR ETFs out there. I'm going to give you some really interesting alpha here in terms of how to use these. Now, you don't always have to wait for them to give you a bullish signal to buy. What you can do is you can just simply see if these sectors are in a bull cycle or a bear cycle. Now, your indicators can tell you that, but a good baseline can simply tell you that too. Is price above the baseline? All right, well, you're good to go. Is it below? Well, maybe you should look elsewhere. Simple as that. Yeah, you don't always have to put too fine of a point on these. But if the rest of your algorithm is giving you a signal one way or the other, then yes, absolutely take note of that, especially on the monthly chart, because you might get one bull signal a year or one bull signal every 2 years on this. So you may want to act, or at least really consider it, depending on if you're trading big board stocks or investing in big board stocks right now. But definitely once the commodity cycle has ended and we start rotating back into these, you are going to want to have a strategy here already in place. But just know there are different ways to approach this. I'll give you another strategy here. If you want, for some reason, especially after we've made our money and we're just really kind of getting that nice maintenance mode, give me a good 10, 15% a year and let the rule of 72 take effect and let's just kind of chill. You might want to discover ways, creative ways, to reduce the amount of risk you take in the thing you want to invest in. So let me tell you how to do that. If you have a hot signal on a JP Morgan, for example, but you know that it might be volatile. Maybe by then banks are under fire a little bit. We're moving over into a new financial system. Who knows? But you're getting a bull signal on JP Morgan, and that's pretty good. But you're worried about possible future volatility. Well, what you can do is you can put half of a position on JP Morgan and the other half in XLF. So you're playing the bank and the sector at the same time. Again, sounds kind of unexciting, but this is the moment we're all kind of hoping for, when we don't really have to chase asymmetry to be in a really good position to either retire or just sit on our gains and our dividends. I mean, that's the life. And probably by then there's not going to be a whole lot of asymmetry out there anyway, so this is going to be where you want to go. And if you want to reduce your overall risk with any of these stocks, the best way to do it is to go half in the stock of your choice because it's giving you a bull signal, and then put the other half into the sector SPDR itself because it is probably also giving you or has already given you a bull signal as well. That way, if the stock does something ridiculous, then it's not really harming your overall, retirement / dividend / whatever portfolio that badly. So that is tip number 2. Tip number 3, the final tip of today's episode. You guys have noticed I've been doing this lately. I've been saving the best usually for last, for those of you who have stuck with me all the way to the end. And I love this one. I really do. And anybody who read the blog this past week, this might not surprise you at all. But you can take these sectors and simply see what their monthly chart looks like and see if it's giving you a bull signal, bear signal, if it's above the baseline, below the baseline, whatever. Smart move. Good strategy. What I kind of like even better is if you take the sector and measure it against the overall S&P 500. So for financials, for example, you would type in on TradingView XLF/SPY. Why would you do this? Well, sometimes the market overall is in a bull cycle, which means most of the sectors in it are also going to be in a bull cycle. And that might not be tremendously helpful to you. You're like, well, I looked at all the sectors, and 23 out of 24 of them are in a bull cycle. So well, now what do I do? I can't really use that information. Well, if you really want to see which sectors are outperforming their peers, and by peers I mean other spiders, you would simply chart them against the SPY. And to me, that's a perfect way to tell. That's a superior way to tell, in my opinion. But I bet you Wall Street's not doing that. In all fairness, to their credit, maybe some firms are, but I would wager to say the majority of them are certainly not. They're just too rigid. They have that fiduciary duty. They can only do so many things. And most of the people who worked there, went to a good college, and these colleges didn't, as colleges often do, they don't teach a lot of creativity. It's also very rigid, very structured, very follow the rules. But this is exactly where peons like us can get the upper hand by finding creative ways to gain advantages over the people who collectively, at least, are widely known as the best and brightest minds in finance. It's guerrilla warfare out there, contrarians, and we just happen to be the best at it. Show me a group of people who are better. You can't. And it's tools and strategies like this that you can carry with you for the rest of your life and have a distinct advantage over the competition for the rest of your life. If something like that doesn't excite you, then maybe you were never the long game player I thought you were. But I would be willing to bet that the majority of you are. And you understand taking strategies like this and adding them to your ever-increasing repertoire, and even putting them into play now, when even in our world, things like gold and silver are all the rage. It might seem crazy, but it's not. You're just early.